On July 9th, S&P cut Oracle to triple B minus, one notch above junk. The stock went up that day. The bonds were already trading like junk. Somebody is wrong. That disagreement is this whole video because the argument over whether AI spending pays off has moved out of the stock market and into the credit market. The transmission map. Here is the map. Capex outgrow cash flow. The gap gets funded with debt. Some on the balance sheet, increasingly of it. Credit starts charging more, and the risk lands in pension funds and ordinary portfolios. One thing upfront. None of this has broken. Spreads are wider, not distressed. This is a map of the plumbing, not a prediction that it bursts. Cash generator to cash consumer. For 20 years, big tech generated cash. In quarter 2 of 2026, Alphabet reported negative free cash flow, its first negative quarter since 2004 IPO. Amazon's trailing capex has run past its operating cash flow. And as per the FactSet data, incremental debt went from 9% of capex in fiscal year 2024 to 32% by mid 2026. $3 trillion shadow ledger. Now, the part nobody prices. A Wall Street Journal analysis in August put 9 big tech firms at roughly $3 trillion of balance sheet AI commitments, against about 600 billion of reported capex. 1.2 trillion of that is uncommons leases, 4 times the prior year. This is legal and fully disclosed. It's just not in the number everyone quotes. Absorbing the supply, rejecting the hold. So, how is the market taking all this supply? It's the buying deals and refusing to hold them. Of 91 hyperscaler bonds issued in 2026, 78 were trading at a higher yields by July 28 than at issue. Median 22 basis points wider. And these names double their index weight in a year. If you own a bond fund, you own this trade. The Hyperion template. Here is how the off-balance sheet part actually works. Meta's Hyperion site is Lucina sits inside a special purpose vehicle. 80% owned by Blue Owl, 20% Meta. Morgan Stanley arranged about 27 billion of debt, with PIMCO anchoring. The SPV owns the data center and leases it back. Meta arranged roughly 30 billion for an asset it controls and occupies without 30 billion of debt on its balance sheet. Nvidia's $500 billion. Then, on August 10th, Nvidia signed agreements with Apollo, BlackRock, Blackstone, Brookfield, Goldman, and KKR to mobilize over $500 billion of third-party capital. These are the Memorandums of Understanding, MOU, not the final documents. 6 of the largest allocators on the earth helping fund purchases of one company's product. The BIS calls this circular financing. The wrong crack. Now, here is what the most coverage got wrong. When situational awareness blew up in July, 45 billion down to 10. That was not a credit event. It was 4 times margin leverage on the concentrated equity book. No debt defaulted, no bond was impaired, no lender lost money. The fund didn't lose the argument, it lost the ability to wait. The canary. Back to Oracle. The one place this mechanism has produced real consequences. S&P named OpenAI a key credit risk with roughly half of Oracle's $630 billion backlog tied to that single customer. It also pulled $260 billion of lease commitments into adjusted debt. Equity bought the backlog. Credit priced the balance sheet 6.5% on 10-year paper. The CDS radar. The default insurance market agrees Oracle 5-year CDS ran to roughly 215 basis points. From about a 40 a year earlier, Nvidia 82. But here is the honest caveat. And it matters. This market is thin. Average daily tech CDS volume last quarters was about 4% of the broader market. Apple went an entire quarter without a single trade. A small hedge moves the price a long way here. The diagnostic. So, Steelman the bulls, because their case is real. Borrowing at investment grade spreads pre-funds the build without draining cash. If revenue misses, holding debt beats being out of cash. Leverage is still historically low. The bear counter is narrower than the headlines suggest. Chips carry 5 to 6 years of useful lives against maybe 2 to 3 years of economic life, and amortization compresses margins through 2027 regardless. Historical analogies. The analogies help, but only if you know where they break. Telecom fiber was funded by pre-revenue issuers. This is funded by the most profitable companies on earth. Railway track lasted 50 years. GPU useful life is contested at 2 to 6. And 2008 was a credit quality crisis inside leveraged banks. This is a valuation question in highly quality credit. What's the regulators say? The BIS named an AI capex burst, circular financing and sovereign debt as its three pressure points for 2026. But read the whole report. It also said the immediate risks look moderate because the spenders are profitable firms with a real cash flow. That line gets cut from the most coverage. The tripwires. So, what would tell you this is actually firing? A second Oracle downgrade into junk, and the largest fallen angel event and the index has ever seen. A jumbo deal repriced to clear, an SPV the banks can't syndicate. Any hyperscaler guiding capex down, that's the real trigger. And the 30-year yield because everything here is priced off it. The chain runs hyperscaler to SPV to private credit, to insurance and pension, to a normal 60-40 portfolio. Broad investment grade exposure is now merely a infrastructure exposure, whether you choose it or not. And AI capex is large enough that a reversal is a GDP event, not a sector rotation. Thank you. See you in the next video.